take a look at the U.S. dollar, catching just a touch of a bid this morning after a theme of weakness for the greenback here as trade tensions ease, with President Trump signing orders to soften the blow of his auto tariffs and Commerce Secretary Howard Lutnick teasing that the administration has reached its first trade deal. Joining me now, Mark McCormick, TD Securities Managing Director, Global Head of FX and EM Strategy. Mark, great to speak with you here. I know that you are anticipating more downside to come for the U.S. dollar for the remainder of the year, but what could a potential breakthrough for the dollar look like?
So I think, especially in FX, you have to think about markets are driven by very different dynamics in the short term versus the medium term and the longer term. So what's kind of happened in the very short term is a lot of it's really based on positioning, technical momentum, and other things that might drive flows. I think what we've seen here is there's a tremendous amount of bad news priced into the U.S. dollar, into U.S. assets in general. And I think what Mark's trying to figure out right here is that while there could be some stand down in the trade rhetoric and some stand down and try to find some trade deals, the most important thing is the effective tariff rate is going to be above 20%. Mm-hmm. So we're moving into a world where there's going to be a lot of uncertainty, a lot of complexity, a lot of volatility, but the reversing of the U.S. trade deficit requires a reversal of financial globalization, which at the core of it is where U.S. equities and where the U.S. dollar lies. So they are going to be collateral damage to any adjustments to the trade deficit. But that's not what's happening in the short term.
And talk to me then about what does drive the short term, given all of the uncertainty, given the lack of clarity on tariff policies, and then also as of this morning, what's actually moving a lot of the tape is that economic data. It's not those headlines on tariffs. Right. So which of those two is going to drive the U.S. dollar more?
It's a great question because I do think, again, we have to step back from what's happening, again, in the months and quarters ahead versus now. What's happening now is that when you look at positioning indicators, we run a whole lot of models and a lot of different tools to tell us what's going on in the very short term, longer term, medium term. But our positioning and short term valuation models are extremely short the U.S. dollar. So we are like seeing a max discount being priced into the dollar. That means that a lot of bad news is priced in, and the market's got to continue to watch data. So whether or not Q1 GDP was good or bad is irrelevant because we know that the market positioned for short U.S. dollar and short U.S. equities in the first quarter. What matters is where things are going in the second quarter, whether or not what's priced in now matches the reality of what's coming through in the second quarter. And that's where we think the market's wrong. This is where we think the dollar is going to consolidate. Again, we saw some data today that's a little bit better than expected. We think non-farm payrolls will be slightly better than expected. And what that's going to do is what I would say here is what's very critical to the working the FX market is that what's happened is that international investors, pension funds, sovereign wealth funds, private investors, all these institutional investors have been long U.S. equities relative to other benchmarks. They have been forced out of those positions. I think most of this, again, in first quarter was mostly CTAs and really high frequency trading. But what's happening is that as the U.S. dollar declined with U.S. equities, they were doubly exposed to these positions, which I think have forced a lot of different investors to increase their hedges to things they're normally not hedged to, which compounded the losses in the dollar recently. So if anything, we start to see the U.S. equity market stabilize, that will help stabilize the correlations and conditions for the dollar, which would allow the positioning and the consolidation of some of the FX markets to work through for the next couple of weeks, maybe even say through the early part of Q2. If we do get this to work out, where the market kind of readjusts its positioning and dollar positioning goes from very short to neutral, we are now in a position to start selling the dollar again, which is where we think the playbook is going to be in the second quarter for the second half of the year as well.
Such a great overview, Mark. I do want to double click on one of the things that you mentioned there, which is the foreign demand. We had a headline crossing this morning, China sovereign fund cutting its exposure to U.S. assets. Obviously, this is a key question right now, the extent to which foreign buyers are fleeing the U.S. dollar. How are you thinking about that risk?
It's very important, and your metaphor is going to be a tub, right? The tub is filled with water, and the water is the pool of assets that have been invested in the U.S. And you're going to turn on the faucets, and things are going to come in or they're going to go out, depending on whether the water is being drained or whether there's water coming in. So if you think about the total stock of foreign investment, the most important thing that you're looking for in the currency market, from the international investment position, the balance of payments, and also the current account, all those three things balanced together. There are accounting mechanisms that show how money moves across the world. The thing that matters the most for those is equities. It's the pension funds, it's the sovereign wealth funds. And what people don't seem to understand is, even if you look at the data, the largest holder of U.S. equities is actually Canada. and then the UK, and then other countries as well. So there are pension funds invested in the US equity market. And if you look at the biggest holder of US treasuries, it's Japan. And again, if like people think a lot about what China's doing, but China's been divesting from treasuries for years. So again, the bigger players here, the thing that we can see is there's a weekly data that comes out from the Ministry of Finance in Japan that shows us the actual movement in capital flows. So we have not seen big divestment in US treasuries from the Japanese. We've seen some forced selling. Potentially that could be year-end rebalancing that you see in Japan on a regular basis, or it could be, again, essentially the institutions are starting to sell US treasuries as a part of, divesting from the US. We don't know the answer to that, but we know what the data is telling us. And there's very little evidence that institutional central banks are essentially divesting from US treasuries from the weekly custody holdings that we get from the Fed. They don't tell us who's selling, they just tell us how much is being held at the Fed for central banks. So again, I think the story is a little bit overdone. I think the asset allocation that we're going to see in the quarters ahead is going to downgrade the US. That's going to lead to a weaker dollar and equity exposure in international investment outside the US. But I don't think that is what's happening now, and the flow data is not telling us that.
Yeah. All right, Mark, I love talking to you. Really appreciate the overview and amazing context for our audience. Thank you so much. Appreciate it.
Thanks for having me.